Why bank collapse in banking crisis? It is essential for banks to have effective risk management policies and procedures in place to mitigate these risks and ensure their long-term viability. Bank collapses can occur due to a combination of factors, including insufficient capital, bad loans, economic downturns, poor risk management, and fraud or misconduct. By following these steps, you can help keep your money safe in a bank and minimize your exposure to financial risk. Hi class! Welcome back to Sir Rob Reed's YouTube channel. Today, we have another interesting topic to encourage you and inspire your journey. Check out SirRobrEid.com, where we address all things practical, financial, and spiritual for your personal and professional development. Also please, hit the notification bell and subscribe. Thank you. Now, please join me as we prayerfully prepare our hearts to receive today's message. Dear Lord, forgive me of my sins, cleanse my heart within, make me whole again, in Jesus' mighty name. Amen. Why bank collapse in banking crisis? Are we watching the banking industry at risk of failing? Does your bank practice proper risk management and oversight? We know that banks, like any other financial institution, are exposed to various risks, including credit risk, market risk, operational risk, and regulatory compliance risk. However, since the housing market crash in 2008, banks have implemented various risk management practices and regulatory frameworks to mitigate these risks and ensure their stability. Additionally, regulatory authorities closely monitor the financial health of banks and have established various mechanisms to address potential problems before they become widespread. In the event of a bank failure, regulatory authorities typically take measures to ensure an orderly resolution of the bank's operations and minimize the impact on the broader financial system. The specific measures taken will depend on the circumstances involved and the regulatory frameworks in place in the relevant jurisdiction. It's worth noting that the global banking industry has undergone significant changes and regulatory reforms since the 2008 financial crisis, which have strengthened the resilience and stability of the banking system. However, banks still face ongoing challenges and risks, and it's important for regulatory authorities and industry participants to remain vigilant and proactive in addressing potential issues. Now in 2023, Silicon Valley Bank is reporting failure. Remember its crisis that occurred in the early 2000s. The crisis was largely centered around the bank's lending practices, which were heavily focused on the technology sector. During the dot-com boom of the late 1990s and early 2000s, Silicon Valley Bank was one of the most active lenders to technology startups. The bank's lending practices were relatively loose, and it provided loans to many startups that were unprofitable and had uncertain prospects. Unfortunately, many of these companies ultimately failed, leaving Silicon Valley Bank with significant losses. Overall, the Silicon Valley Bank crisis highlighted the risks associated with lending practices, which are overly focused on a single sector or industry. It also underscores the importance of effective risk management and sound corporate governance practices in the banking industry. So why do banks fail? Let's discuss some of the reasons for a potential bank crisis. Banks can collapse for a variety of reasons, but some of the most common causes include: 1. Insufficient capital. Banks are required to maintain a certain amount of capital to absorb potential losses. If a bank has insufficient capital to cover losses, it may become insolvent and fail. 2. Bad loans. Banks make money by lending money to borrowers, but if a significant number of those borrowers default on their loans, the bank's assets can quickly become worth less than its liabilities, causing it to fail. 3. Economic downturn. A major economic downturn or recession can cause a large number of borrowers to default on their loans, leading to significant losses for banks and potentially causing them to fail. 4. Poor risk management. Banks are exposed to a variety of risks, including credit risk, market risk, and operational risk. If a bank does not have adequate risk management policies and procedures in place, it may be vulnerable to significant losses. 5. Fraud or misconduct. Banks can also fail if they are involved in fraud or other forms of misconduct. This can lead to significant losses, reputational damage, and legal liability. If your bank or lending institution is at risk, you need to take appropriate and immediate actions. We want you to be happy, successful, and financially secured in life. Here are a few Bible verses for you to remember that pertains to money, credit, and debt management. So let us go straight to the scriptures to shape and sharpen our thought process. I hope this will bless you, strengthen you, encourage your faith journey, and give you peace, as God has promised in His Word. May God add His blessings to the reading and hearing of His holy Word. Amen. Luke 19 verses 20 to 24, and another came, saying, Lord, behold, here is thy pound, which I have kept laid up in a napkin. Verse 21. For I feared thee, because thou art an austere man, thou takest up that thou laidst not down, and reapest that thou didst not sow. Verse 22. And he saith unto him, Out of thine own mouth will I judge thee, thou wicked servant. Thou knewest that I was an austere man, taking up that I laid not down, and reaping that I did not sow. Verse 23. Wherefore then gavest not thou my money into the bank, that at my coming I might have required mine own with usury? Verse 24. And he said unto them that stood by, Take from him the pound, and give it to him that hath 10 pounds. Remember this parable of the 10 servants, who each received 1 pound from their king. This was a practical test to showcase their financial, leadership, and managerial skills. They know the owner was also a prodigious investor, who expected a return on his monetary investment. After a long period of time, after receiving his kingdom, the owner returned and the servants had to show their earnings. One servant, who had received a pound, now had 10 pounds. Likewise, another servant who had received a pound, now had 5 pounds, and so forth. However, a servant who had also received a pound, had just the 1 pound. That servant failed to invest the 1 pound with investors, failed to appreciate an asset, failed to take profits from trading, and failed to at least secure interest in a savings account. Thus, while the other servants were promoted to mayors of cities in the new kingdom, that servant was punished for not participating in the wealth transfer. Conclusion. In summary, bank collapses can occur due to a combination of factors, including insufficient capital, bad loans, economic downturns, poor risk management, and fraud or misconduct. It is essential for banks to have effective risk management policies and procedures in place to mitigate these risks and ensure their long-term viability. Therefore, there are several steps you can take to help keep your money safe in a bank. 1. Choose a reputable bank. When choosing a bank, it's important to consider its reputation, stability, and regulatory compliance record. Is your bank making unfavorable news headlines? You can research a bank's reputation by reading reviews, checking its financial health, and verifying its regulatory compliance. 2. Verify deposit insurance. Most countries have deposit insurance schemes that protect depositors' funds up to a certain amount in case of a bank failure. Make sure that your bank is insured by a reputable deposit insurance scheme and that you understand the coverage limits. 3. Use secure online banking. If you use online banking, make sure to use a secure complex password, and keep your login credentials confidential. Avoid using public Wi-Fi networks or unsecured devices when accessing your bank account. 4. Monitor your account regularly. Keep an eye on your bank account activities often, and report any suspicious transactions to your bank immediately. Most banks allow you to set alerts on account limits, transfers, and transaction due dates. 5. Diversify your deposits. Consider diversifying your deposits across multiple trusted banks to spread your risk and reduce your exposure to a single institution. You can choose your bank based on its national presence, online strength, fee structure, and portfolio offerings. 6. Follow bank security guidelines. Follow the security guidelines and protocols recommended by your bank, such as using secure passwords, enabling two-factor authentication, and keeping your personal information confidential. By following these steps, you can help keep your money safe in a bank and minimize your exposure to financial risk. For more information, please check the description below for links, and go online to SirRobrEid for more resources. Also, check us on social media and be sure to like, comment, subscribe and repost items of interest to you. Thank you for watching, and see you in the next video. Thanks again. God bless you. Amen. SirRobrEid.com